Well, hello everybody. We continue on our journey in fundamentals of advanced accounting, consolidated financial statements, and outside ownership. So we're trying to understand business combinations. We looked at the previous chapter at 100% ownership. In this case, we are looking at less than 100% ownership, but more than 50%. So since we own less than 100%, now we have to account for non-controlling interest. The company that has control over the acquired company is the one that's going to report 100% and also has to report that non-controlling interest portion. So how exactly are we going to account for this non-controlling interest? So we're still using our formula that we introduced in a previous presentation. So basically we had our, before when we own 100%, we had our acquisition price less the subsidiary's net book value. Then that difference was allocated to over and under assets and liabilities. And any difference, if there was still a difference, then we allocated that to goodwill. In this case, since we have a non-controlling interest, then what we have to do is take into account the fair market value of the controlling interest and then also the fair market value of the non-controlling interest. So the acquisition price will be the fair value of the controlling interest. And then we're going to have to sort of, if there's this company is publicly traded and their stock is, we have a trading price for the stock on the date of acquisition, then we can use that as a fair market value of the non-controlling interest. There are some instances where we don't have, this is not, we don't have a trading price fair market value for the stock, and in that case we're going to have to imply or assume what the fair market value of the non-controlling interest is. So we have an example here. We have Parker Corporation wants to acquire 90% of Strong Company. Strong stock is currently trading at $60 per share, but Parker feels that this alliance with Strong is going to increase its value and is willing to pay more to acquire the stock. So they want to acquire a 90% interest in Strong Company. So we have that Parker purchased 9,000 shares, Strong had 10,000 shares, 9,000, so that's 90%, and they're paying $17 per share. So the consideration transferred is $630,000. We can see that here. And now we need to account for the non-controlling interest. And so out of the 10,000 shares, there's 1,000 shares. And we're going to use the trading price for this stock, which is $60 per share. So that's our non-controlling interest fair market value. So we have a total fair value for this subsidiary representing 100%. And now we can continue on with the formula that we talked about in the previous slide. Okay, so we're going to demonstrate the calculation of the consolidated net income. And now we're going to take into consideration the non-controlling interest net income. So we're going to have to split our consolidated net income between our controlling interest net income and our non-controlling interest net income. So the non-controlling interest, so let me go backtrack to the previous slide. The non-controlling interest is only interested in the subsidiary's net income, okay? They don't care about the controlling, they only care about the minority or this non-controlling interest that they own. And so the starting point in calculating our non-controlling interest net income is going to be the subsidiary's net income. Okay, subsidiary's net income. In this case, the subsidiaries is strong. So we start with, we were given revenues and expenses for the subsidiary. We have the subsidiary's net income, and there was amortization. So we have to subtract or add amortization and or depreciation. In this case, we're subtracting, and so we have our subsidiary's net income of 110,000. Now, if you recall, the controlling interest was 90%. The non-controlling interest is the remaining 10%. So we multiply this by 10%, and we have our non-controlling interest net income. Now, you may be tempted to take this amount and multiply by 90% to calculate the controlling portion of the subsidiary's net income, but that would be incorrect. So we have to follow the steps. So basically, we do this step 1 to calculate our non-controlling interest net income is 11,000 in this case. Then we take our consolidated net income, and then we subtract our non-controlling interest net income, and to arrive at the controlling interest net income. Okay, so we don't take 10% of this and 90% of this. We have to follow the steps. Okay, so that's important. And so that concludes this presentation.